Good afternoon, everyone, and welcome back to Powering Ahead Series by Her Money Talks in BSc India. We are pleased to have Mr. Balagopal Chandrasekhar with us today on the second day of Powering Ahead Series during World Investor Week. This session is in collaboration with BSc India's Investor Awareness Program. To the viewers, Mr. Balagopal Chandrasekhar is currently the chairman of Federal Bank. He is an ex-civil servant turned entrepreneur who made high-tech biomedical devices for the first time in the country, which turned out to the largest blood bank systems in the world. He is also on the governing body of several organizations, including the Center for Management Development Trivandrum, the advisory board of Fourth Wave Foundation, member of the board of TimeNet Medical Devices Incubator of SET IMST, and member advisory board of IIT Palakkad. A warm welcome to you, sir.
Thank you for that generous introduction, Nisari, and I'm looking forward to our conversation.
Sure. Today's topic is getting time on your side as an investor. In this current times of global crisis and all other, the market is buzzing with information. People have a lot of confusions, which is the right time to invest, where to invest, and how to exit from an investment. So we are hoping to discuss all this today on a perspective, on a generic or a personal perspective from Mr. Balagopal.
So I'm glad you mentioned that personal perspective here, because I'm here, whatever I say will be my personal experiences as an investor. This does not represent the views of Federal Bank. And so I think I just wanted to make that very clear.
Sure. So we are living in a time of mixed market sentiments. There are several global crises happening, like the Ukraine crisis, oil price fluctuations, Sri Lankan crisis, and so many concerns, and the Sensex is bouncing around. So what do you feel will be the small investor's frame of mind with respect to investment opportunities at present?
Yeah, you're right about these are not exactly calm and predictable times. Even in the best of times, the stock market is something which is very difficult to predict. And as many of you all know quite well. But at this time, with the news of, with bad news of economies slipping into recession, and especially in neighboring economies like Sri Lanka, Pakistan doing very badly, even Bangladesh, which till recently was doing well, has also started doing badly. And China, which has been powering global growth for the last decade or so, has also been experiencing slowdowns, which are being attributed to various reasons. There is rising inflation in Europe and in the US, and the US has recorded 2 successive quarters of negative growth, which is technically means that the US is in recession. So because of all that, I think these would be times to be when it is best to be prudent, especially since we are talking about the small investor. That fear and anxiety is very normal at this time. And I think the basic approach should be guided by prudence. Then obviously, since India is also not immune from, though the Indian economy appears to be growing better than many other large economies in the world, still I would advise caution, because when you talk about the small investor, obviously they need to look at their income, because salary growth and bonuses and all that could be muted this year going forward. So as well as in some sectors, there could be apprehensions of potential job losses, layoffs, and other such negative developments. So this is for the small investor. But even among these small investors, there is a small category called, I would call, the informed investor. Now, for the informed investor, I think these times represent usually opportunities for discount buying and acquiring assets at good valuations. So this is it's a kind of two aspects to the same situation. While the small investor who is not very conversant with the market, who is entering the market, who is just beginning to build a small portfolio, would be advised to be very cautious and should actually discount the future discount the future at this stage. For the informed investor, this phase can actually be a phase of opportunity for buying at a discount.
So taking a short-term and a medium-term view, how do you see the markets will be playing out? And what are the precautions the Indian investors should take with respect to their current investments and while choosing their future investments?
Here in this case, again, I'm just saying from my personal experience in these matters and what I hear anecdotal from friends who have made investments and made some mistakes, etc. In the investment game, one needs to take at least a medium-term view. In my opinion, a very short-term view, entering the market with a short-term view is a recipe for trouble. Because investors will tend to be a little adventurous, will be guided a lot by very daily short-term movements in the share prices, and will listen to, there's a lot of advice floating around on various subjects from various sources, which are all of very questionable value. And so the small investor particularly would be advised to take at least a medium-term view. At least a 5-year perspective must be taken. And the whole idea must not be, all right, I'll go in with at this price and I'll exit at this price, or I expect the market to go up, because the market never behaves in the short term the way you want it to behave. It's as we, take a pull back from the ground level view to at least the first floor view, the second floor view, and if not the helicopter view, that we tend to see that all those little fluctuations average out, and then we can discern a rising trend or a declining trend, and then decide, all right, this market, this particular stock doesn't look as though it is in a good place right now, and I won't enter it, etc. So I think it is the time element. I would recommend people, even those who are especially those who are starting an investment portfolio, should start with a reasonable time frame and not enter it thinking they're going to make a lot of money immediately.
Yes. Coming to timing of investment, it is not just the timing of a purchase, but exiting too. A thing that many people doesn't know is when to sell your shares or your mutual funds, or when to exit from an investment. What is your opinion about this?
See, there are some, there are some general rules, not rules, there are some general practices which are followed, that, you buy when the price is still falling and you sell when the price is still rising. But that, it's very easy to say, but it's very difficult to do, because when the price is rising, you'll think, all right, I'll sell it, I'll just wait for one more day. And, that's human nature. You won't look at the fact that on that day already you are getting a decent return and you should get out, because you don't know what's going to happen tomorrow. So this whole idea that what happened today, let me just wait one more day, is actually what gets many people into trouble. So the wise, savvy investor knows, just look at the return you have already got, and if that meets your expectations, exit, sell, and get out. And similarly, when the price is dropping, don't keep waiting, saying that, if already it has reached a level where you expect that that's a reasonable level at which you think it's going to. That's one way to look at it. The second way is also that I think the small investor would be advised to break up his purchases or her purchases in this case to more than one packet, in terms of, so that you can, which is where these SIPs come into thing, because you keep buying when the prices are still moving, whether they're moving down or up. And so your average cost of purchase, you'll be averaging out, it will be declining with every successive purchase which you're doing. So I have made this mistake of holding on to something, thinking that, since all the indications are that this is going to keep going up. And so I held it. And then it just dropped like a stone the next day. And all the gains which are on paper, the gains which I had say for the previous few months, all evaporated in one day. So that I think many people have such stories to say. So the prudent investor will always book the profit when it has already crossed. Some internal triggers must be, trigger values must be set. And one mustn't be guided by stories which you hear and people say, please don't sell, hold on to it because I've heard this particular thing. So I think those are some general, practices to follow.
So it is all about having a mental calculation, like what is an average or what is a decent return you can expect from an investment. And when you feel you reach that level, it's time to exit. Same.
Exactly. Yes, exactly. That's what I would suggest. But see, here again, I must say another thing is, for the small investor, I would not suggest this kind of daily, even unless one has the time to do that. This is a very time-consuming thing. You can't just spend 5 minutes on just looking at a stock price and decide. You need to track it. You need to look at what was. So all this requires a lot of time. And for young people who have a job, who have things to do, I would not advise spending too much time on this, because quite frankly, as a person who is very keenly interested in economics, what I can tell you is, notwithstanding all the pages of writing which you find in the business pages of the various media, this is not an exact science. This is all guesswork. Let's be very frank about it. Despite all the mathematical modeling, no way has been found to predict what is essentially an unknowable future. You don't know what is going to happen tomorrow. No matter what the pundit tells you, you don't know what's going to happen tomorrow. So it's a toss-up. It's a flip of a coin, actually, if you put it in very. So in such a case, what the good news, that's the bad news. The good news is that if you take a reasonably long time frame, then these various ups and downs of the daily, and even within the day, the hourly kind of ups and downs, and then within a week, the fluctuations, all of them average out, and one can discern a kind of a trend. So in my opinion, I would actually recommend to small investors not to look at the stock price every day, because that will just, they will lose sleep, they will get tense, their blood pressure may go up, and they really are not going to gain anything, because there is, as I said, there is no scientific way to find out what is going to be the stock price tomorrow. Another bit of advice necessary, which I would give to your members and people who follow your column, your advice is that I would suggest to them not to spend time every day tracking this thing. This may be counterintuitive advice, because it's not going to add to their knowledge. It's not going to improve their understanding of economics, quite frankly speaking. And they will unnecessarily get worked up, and they may often take the wrong decisions. So connected to this is another point which you may have intended to ask me, is in terms of an investment, what kind of investment approach to take. I would suggest, even for the especially for the novice investor, for the person building an investment portfolio for the first time and planning to start small, get an advisor and listen to her advice. Don't try and second guess them. Don't waste your time trying to understand, because they know far more than you do. Follow the advice, and in choosing, be careful about choosing the advisor. Choose an advisor who seems to be who seems to be sensible, who seems to be prudent, who is not offering you sky-high returns, and who is saying, I'll double your money. Those kind of people are also available in the market today. But you must take somebody who gives very level-headed, balanced advice, and follow the advice. In fact, that is one of I hope will be one of the takeaways from this conversation is, I want to tell people, don't try and become an investment expert. It's going to take a very long time to even understand the market.
So the takeaways are, you need to plan or think on a long term when it comes to investments. And rather than getting panicked by the market ups and downs, you need to wait patiently. And thirdly, of course, it is just like consulting a doctor when you are sick or when you need a medical advice. You consult an investment advisor, or you need to have an investment advisor to take the right decisions when it comes to your financial planning. I know investment philosophies are always subjective and very personal. So what are the top 3 do's and don'ts personally you swear when it comes to investing? And can you share any incident or anecdote that comes to your mind when it comes to your investment journey?
Okay. One of my investment advice, I have an investment advisor, and I really trust them a lot. And I have a regular regular calls with them. And I've come to respect them a lot, because they very quickly were able to understand me as a person. Even though I may have said one thing, they understood what I really meant, because they could make out from my responses that even though Balagopal is saying this is what he means, that he is actually quite risk averse. He is looking at more capital preservation. He is looking at and a modest rate of return to say beat the post-tax. It must beat the FD rate or beat inflation. Actually, that's my expectations have been pegged down. So the do's I would suggest are spend some time talking to this investment advisor to understand your personal risk appetite, your risk profile. Many people think, oh, I'm a risk taker, I'm this, I'm that. But by the time an advisor talks to you for 10 minutes, they would have already understood that, no, this person actually is very risk averse. He thinks it's very cool being a risk taker, but actually he's very risk averse. You don't have to follow what your friend is doing and what everybody else in your office is doing. Do what is best for you, and that you will understand only if you talk to a fairly sensible advisor who will tell you, this is what your risk appetite is, and this is, don't do this and let's do this. So that's the first point. Second is, of course, what I think all people would advise is, which is have adequate diversification across different asset classes, such as safe investments, equity-based funds, gold, real estate. So one must have and this actually, if you look at it, these are big words, and everybody will think this is all very high funda, financial jargon. It is not. That's the way we behave. That's the way ordinary human beings behave. We always hedge our bets. We always try and see that we don't back only one horse. Diversification. And third is related to what the first two things which I said, and which I will repeat again. Take professional advice from a good advisor. So these are the 3 don'ts. I mean, do's. Don'ts, what I would suggest are, one of the biggest mistakes many people think is, what they call this fear of missing out, this FOMO. So they'll say, look, if you don't buy this share today, you're going to miss out on a bonanza of the century. Now, these kind of sales talk And the problem is most of us are really, we fall for this because, actually it is very interesting that one may think that, as your knowledge of finance improves, that there is an inverse relationship between your knowledge of finance and the kind of foolish mistakes we make. I find there is no correlation between the two. In fact, during there was an era, say 20, maybe 30 years ago, when finance, money lending companies were known as blade companies. And when these blade companies were at their peak, they were offering sky-high returns. You will be surprised at the number of management professors of finance management from business schools who lost their life savings putting the money into blade companies. Now, can one say that these people did not know finance? I don't think so. They understood finance. They were teaching finance after all. So they understood about risk. They understood about portfolio diversification. They understood all that. Uncertainty and all. Yet they went and so this is human nature. Second thing is don't speculate. See, this trying to anticipate what the market is going to do is a very big mistake, because we are then straight away putting on a hat which is completely unfamiliar. We don't know that business sector. We don't know that that sector of the economy. Say, supposing it is a petrochemical stock. We don't know the petrochemical industry. We have never seen even the profit and loss account or balance sheet of a single petrochemical company. We have not even probably studied the financials of that company. We don't know the sector in India. We don't know the global scenario. And here we are trying to speculate whether the share is going to go up or down. How do we know? On what basis can we make that statement? So don't speculate. And third is, this is very important, I think, is don't allocate short-term funds to equity-based funds. In other words, it's like saying, don't mix insurance with investment. Because, see, in the old days, people used to say, this is a product which is linked to insurance. No, that's actually, and many people made big mistakes. Insurance tries to address one particular concern of an individual. Investment addresses another concern of the individual. Insurance addresses that, supposing, say, for instance, all of us, when we buy car insurance for our car, we don't expect to make some money out of that investment in the car. I mean, it's an insurance because, and we write off, that amount is written off in that year's expense. So it is a fully written off expense. It is expensed in that year. Whereas investment is something completely different. Investment is the same 20,000 rupees which I spend on insurance is written off. I have already got what I want, which is peace of mind. I have got, because of that is freedom from the fear of third-party claims and all sorts of other claims and repair claims for my vehicle, etc. Now I have peace of mind. It's a sleep easy thing. I got peace of mind. Insurance is different, where I have got, say, 20,000 rupees, which I want this 20,000 rupees to grow so that it beats inflation, so that my net worth will be growing year on year and creating security for my business. I mean, for my business or for my family. So these are two completely different things. These are broadly the do's and don'ts which I would suggest.
Okay. Just a quick question I'm adding to that. In fact, it is a practice which I see many people do. Like when it comes to a stock or a shares purchase, they go, or a mutual fund investment, they go and consult an investment advisor. But when it comes to all other type of investments, they never consult. For example, real estate. This is mostly, it's more emotional. People are more emotional. And they don't consult their investment advisor, and they find something and they directly go and buy it. Or similarly, it's gold. When you do these kind of investments, you never consult. So what is your opinion? For all kind of investments, should we consult an advisor? Yes. Or is it just restricted to shares or equity investments?
This is a very, very good question. And in fact, this question should be the question with which any discussion with a first-time investor should start. Because when we say we're going to build a investment portfolio, what actually the person is, you are actually investing in your future, in the future of your family, and that's what you're investing in. And then, your advisor will advise you saying, don't put everything into financial assets. And even within financial assets, don't put everything into stocks and shares. Put some into, even within stocks and shares, put some into individual stocks, but put more, if they are a cautious type, put more into mutual funds. And then for the rest of the financials thing, they'll say, put it into fixed income, things like, debt instruments and treasuries, put it into things like that, which will give you security, though maybe lower return, but very steady, very, kind of sure kind of return. So now they will say, so don't put all your money into financial assets, which means what should the rest of it go to? They will say, put a little bit of it into real estate, put a little bit of it into gold. Now, so once the person realizes that all these form part of the investment portfolio, so the problem is most investors think investment is what I have in stocks and shares and in mutual funds, or in fixed deposits. But the house which I bought and the plot or that flat which I booked and all, they don't look at it as investment. They think that's for my daughter, that's for my... Now, I think this is very important because my eyes were opened up by my financial advisor when they presented me with data showing over the last 30, 40, 50 years, financial assets have outperformed real estate by a mile. But, all of us have heard anecdotal stories of, oh, my friend bought this plot for 1 lakh a cent and then it went up to 50 lakhs a cent, and everybody dreams of, making that kind of money. But those are historically like almost like black swan events. They happen once in a while. But what happens generally is real estate goes up steadily. But financial assets have grown much faster than... Now, many people don't know that because the common man really doesn't know that, because what conventional wisdom is that real estate is the best investment, whereas it is not. So not only has it not grown in value over time as much as financial assets, but it's also illiquid. When you want the money, you don't get it. And when you want the money and you try to sell a piece of property, then you find in a seller's market, you are getting much less than what you thought that property is worth. So I think it's very important that, as you said, every decision you make, because every decision to buy, say, gold, a piece of jewelry or a piece of property or a mutual fund is an investment. All investment decisions you should take only after consulting your financial advisor.
Comparing India with the Western economies, we know that, Western economies, there are matured investors than Indian investors. So what, according to you, should Indian investors continue in our paths when it comes to investment styles and choices? Or is it just a matter of time before we adopt Western investment practices and outlook? What do you think? What is your opinion about this?
Actually, you're right about the fact that the Western, the developed countries, not just Western, developed countries, OECD countries, the stock market systems are well established. The understanding of the stock market, the awareness of stocks and shares, and the kind of returns which they can give among the common citizenry and all that is very high, much higher than in the case of India. So that's a fact. But I think in fact, there is the Tarun Ramadurai committee, which was appointed by the Reserve Bank of India to study household savings and household savings behavior. They came up with some very interesting findings, which showed that the top quintile of the income distribution, the top 20% of the income distribution and the bottom 20% of the income distribution, the investment behavior was almost exactly the same. That's very counterintuitive. One would imagine that the wealthiest people would be very savvy about stocks and shares, and they will be watching all this. They will be looking at ROI and ROA and all that stuff. And whereas the guys in the lowest 20% of the income distribution will be thinking very simplistically. So they found that, the Ramadurai committee found that the lowest quintile invested most of their money in real estate and gold, with most of the investment going into real estate and the rest of it going into gold, with only very little in bank deposits or anything. And what about the behavior of the top quintile? Almost exactly the same. The top quintile also invested in real estate, invested in gold, and a little bit went into financial assets. Now, what does this mean for the Indian stock market? It's actually very good news. The BSE and the NSE are already among the largest stock markets in the world by total market capitalization, and also number of transactions, number of players, all that. If you look at it in volume of trades and all that, they are among the largest in the world, with only a very small proportion of the Indian population being active investors. So that's the good news, which means that India and China are the two who are going to become the giants in the... China is already becoming the giant, but India is the next emerging giant in the financial investment space, as household savings start finding its way into financial assets, more and more into financial assets, instead of being exclusively preoccupied with. So one may see the long queues and the big rush in the jewelry shops and all coming down maybe in the future. But I think you will find that a lot of that money starts flowing into the stock markets. So that's, I think, the good news. So I think the sophistication of the Indian investor is changing. In fact, recently, when the quantitative easing, when the interest rate rise by the Federal Reserve System was first announced a few months ago, one was expecting a massive outflow of funds from the Indian, and they were expecting that the markets would actually really drop very, very steeply. While there was a drop, what astonished people was the fact that almost the entire outflow was compensated by money flowing into the stock markets from domestic investors, and who were retail investors, who were the ordinary ordinary people who started putting in the money. That means several billions of, hundreds of thousands of crores came in to take up the slack. So that's the good news for these Indian stock markets is, I think, as more and more of the retail investors, the ordinary people start coming in, you will find the strength and relevance of instruments like mutual funds, etc., will start growing. And already the mutual fund sector in India it's amazing. Its month-to-month growth is really baffling. Even experts all across the world. It's growing month to month by thousands of crores. So that's all the good news. So I think it's becoming a market which is becoming more sophisticated, better. And thanks to SEBI finding that there were, many practices which were happening in the investment community and investment sector, they have brought in stringent regulations for regulating financial advisors. And so, in fact, the number of SEBI registered financial advisors is actually pretty small. And there are even large marquee brand names have all exited that space and prefer to just stick to investment banking and all, and are leaving the financial advisory space because of very stringent disclosure and compliance requirements. So I think the market is getting sophisticated. It is getting so that the small investors can feel more comfortable that her interest is going to be looked after by strict regulation of the operations of the market players and the investment advisors, etc. So I think it will become more and more reliable as a place to go to and put your life savings into, and expect returns to which will be higher than what a bank deposit can give, and which will also help in beating inflation so that they are able to stay ahead of the curve.
Okay. Now, circling back to your point that Indian economy is growing, and that too on a healthy clip as compared to other advanced economies. What do you think? Why do you think it is due? It's due to what, according to you?
Oh, and in my opinion, see, I think it goes back to very basic economics. I don't think it is because of, there is, one is tempted to say that it is because of government policies and here in India, and or some people will argue that it is because of international developments which are favoring India, etc. I would say that, if you look at the basic concepts of economic development, we are very low in that gradient, in that curve, growth curve. So we have a very long way to go. Today, our per capita GDP is a little over 2,000 US dollars. And on, if you take it on nominal rates, and PPP is actually, in my opinion, the more relevant measure is actually PPP, because when you're earning in rupees, it's what your rupee can buy, which matters, which should be compared to what a dollar can buy in America. So that is what should be compared, and not converting the rupee into dollars and saying, divide by 80 or 82 or whatever is the current thing, and then which will discount the whole thing. So despite this fact of, in per capita terms, India will be classified probably as just still a poor country, just emerging from not even lower middle income and all those kind of classification. We are a poor country. But when you also when you look at the other side of the picture, it's very interesting. India is the largest producer of milk in the world, the largest producer of eggs in the world, the second largest producer of rice in the world, the second largest producer of wheat in the world, and the second largest producer of vegetables in the world, the second largest producer of fruits in the world. Now, how many people realize all this, And we are producing in such massive quantities that we can even export if we have to. The largest buffer stock of wheat and rice food grains in the world is held by the Food Corporation of India in its thousands of warehouses across the country. We have enough food grain stock here to fundamentally crash the international price if we want. We have so much stock here. So my point here is, and then if you look at steel production, we are the third or fourth largest steel producer. Cement, we are the second largest steel producer in the world. Cement producer in the world after. So at these, why I mentioned all this is, agricultural commodities is what 1.4 billion Indians need to eat. And to keep their body and soul together, they need this. We are among the largest in almost every category of those products. Very different from 50 years ago when we were really a poor country. Here, our per capita GDP is still low, but we are not a poor country anymore. We are making a lot of this. Now, in industrial products, we are the third or fourth largest automobile manufacturer in the world. How many people know that? So cement, we are the second largest producer. Steel. Now, as I said, cement, steel, automobiles, railway, rolling stock, and fertilizers. We are the second or third largest producer of fertilizers in the world. So these are the essential building blocks for building an economy. And India makes all these products. So, and we don't need to depend on foreign technology or foreign know-how for all this stuff. We have the technology ourselves. We can set up steel plants anywhere in the world. We can set up cement plants. We have our own, high-tech departments like atomic energy, spacecraft, and all that. So we have the knowledge, we have the wherewithal, and now the financial power is also growing as more and more savings come into it. We have some way to go still, because our taxation, tax collection as a percentage of GDP is still very low. It's only around 10%. Whereas for all the OECD countries, it's over 30%, 35%. For us, it's only 10%. Now, when you have 10% of GDP only tax revenues, how do you expect the government to provide good roads, good airports, good railways? It has to be funded by something. So I think tax compliance has to go up. The tax net has to go up, which means revenue intelligence by the government has to improve. So all these are very doable things. These are all within our power. And if we have a good, strong, and and non-corrupt governance, both at the center and in all the states, then I think you will find that India is one country which in the next 10, 20 years is going to become the powerhouse of the world. Just like China for the last 20 years became the engine of the global economy. The next 20 years, I think, or 20, 30 years is going to be India's turn.
That's an interesting topic, but due to the interest of time, I think we have to move to the next topic. So a slightly different question here. We talked about asset allocation and all, portfolio and all, but now see our community members, we have a lot of millennials and women who may be earning less, or who are on a career break, or not earning much to have a diversified portfolio. So what is your opinion? What is your advice for them? How they can have some kind of small investment on a long term for their future?
One of the great things which has happened and which has been enabled by technology actually is that the ticket size no longer really matters. You can really go in for, and if you see the share, the lots, and the minimum amount which you can invest into, all that has been changed by the fact that digitization has happened, in dematerialization and digitization has happened. So there is no minimum amount which you have to invest at least before you can become a serious investor. You can start very, very small. So my advice is both for aspirational, women who are housewives, who the children have started going to school and now want to do something, or people, especially this applies more to people who are entering the job market, who are going to get their first paycheck. They are the people who should start having an investment policy and an investment portfolio right away. And they should start with the SIPs. And but even there, in my opinion, they should get the advice of somebody who knows the market. Even if that person may not be formally appointed as an investment advisor, they should try to find out their bank manager or a friend of theirs who understands the stock markets and financial investment, and take their advice about starting small. The beauty of starting small is, see, for people, as you get older, when you get to your 50s and 60s and all that, what you don't have is time. But when you're in your early 20s or in your mid 20s, what you have is time. And if you don't make use of it right away, you lose a lot of advantages there. So if you start with an SIP, which may be just 500 rupees a month or 1,000 rupees a month, you may be getting a salary of 25,000 rupees. You're not going to miss this 1,000 rupees. But just putting it aside, and the thing about the SIP is, regardless of what the NAV is, you're buying at all prices. You're buying it when the price is going up, when the price is coming down. So you're averaging them. And always you will find at the end of 1 year, you're pleasantly surprised when you realize that, oh my God, how did I have so much money? Almost always the SIP surprises the investor because its value seems, because the other thing is about human brains is we don't understand compounding. We don't understand compounding of money, the growth of money. Compound interest, we don't understand it. It's not something which we intuitively are able to understand. Simple interest we can understand, but compounding we don't understand. So for us, the fact that if you take, say, 1,00,000 rupees and you invest it prudently at, say, 10% rate of 10 or 11 or 12% rate of interest, the fact that in 5 years it's going to double is counterintuitive. People think, how can that be? How can this double in 5 years or 7 years? Because you'll think it will take 10 years at least. No? That's and then when you explain it to them with numbers, that's when you see their eyes widen and they realize that, oh my God, I never realized that. So most people don't understand that to have an investment portfolio, you don't have to put in large amounts of money. You can build a portfolio over time. But the important thing is then you mustn't waste time. As soon as you get your first paycheck, put aside something into that. And then, watch it grow. And then put it there, and like they say, put it, invest it, forget it. And then don't go back and keep on looking at what is the NAV today. I made that mistake. And I, unfortunately, when I should have exited, I didn't exit, in fact, and when I, having been through the worst times, I should have stayed longer. If I had a proper time horizon, I would not have taken all these wrong decisions. I took the wrong decisions purely based on what I felt the market was going to do and what they call this FOMO, fear of missing out. Oh, if I sell now, I'm going to miss out on a real bonanza. Or if I sell now, it's a loss. I'll wait for the share to come back up, and it never comes back up. And it just keeps going further down. So I think the thing is to start early and start small and be there regular. Every month that amount must go. So that would be a certain amount which is an allocable amount, and which is you must say, I will not touch that amount. Now, some people may have a inclination for playing the stock market. Then what they can do is set aside a small corpus from their again, like a little bit of pocket money which they can set aside, and then they can go and indulge themselves in trying to beat the market and all. I wouldn't recommend that because I think it's like gambling. So that part of it. But if those who want to do it, they should not tinker with their long-term stocks and long-term investments. They should not touch. They should leave all that, and they should play around only with money which they can lose and not miss.
Thank you so much for your time and having been with us here today in such a short notice. It was a very interesting discussion. I know there are a lot of takeaways for the viewers today, especially the millennials, the women, and even the families who are watching this. Once again, thank you so much for being with us today.
Thank you for having me, and I enjoyed the conversation. Thank you.
Thank you, sir.